Hello, this is Sunny, and this is my 31st December outfit. Judge all you want as far as you're having a good time. If you already judged and you're not having a good time, go have a good time tonight to make up for it. So, apart from showing you still some tourists pouring in for Christmas, what I'm doing now is, if you didn't hear about it, I released a podcast episode yesterday, or day before yesterday, about what is going on in the markets right now and what you should do, right? So it focused on three things. First, why is market falling? Second, is recession near? Is recession coming in 2019? And third, what you should do now. So in this video, I thought about doing an IGTV video about like 5-10 minutes, pretty quick recap of what it was and what I said. Of course, I hope you listened to it. But now, talking about a quick recap. This will be quick, so I will go over the main points, okay? So I hope you all had a good 2018 so far, but I'm pretty kind of sure that you wouldn't have a good year in the market so far, right? Because markets were down 20% from their highs. Not a good year for the market, although on a whole the market is just about 5% down, not a lot, but 20% from the highs. The S&P valuations went down from 18.5 times forward to 14.5 times forward. So that's cheap. That is 14.5 times as cheap is what I'm saying. So the question is the market now a screaming buy? The answer is, from my perspective, it's a buy, but maybe not a screaming buy. And then you ask if it's 14.5 times, and if I say it's cheap, then why is it not a screaming buy? That's how I go on to a segue and say that another fact you got to know is the expectation game is broken. Every once in a while, expectation games get broken. What happens, what do I mean by that, is every time you say something is cheap, you're basically believing that whatever the numbers are, you're believing the numbers and basically dividing by the earnings and saying the price is cheap. You're believing the estimates if you're believing something is cheap. But there comes a point when the expectation game gets broken. So for example, if some stock is very cheap, probably the reason is nobody believes the company is going to earn what they say it's going to earn, right? So right now what's going on in the market is all the cyclical sectors, right? Housing, autos, semis, they all are super cheap. They all are like 5 to 7 times forward earnings. So we shouldn't be too bullish because they're so cheap. We should see what's going on under the surface. So if all cyclicals are super cheap, what does that mean is the market on a whole is believing that we're in top of the cycle, right? That they're all believing all the cyclicals are going to have a drop in earnings. When does that happen? When do all cyclicals have a drop in earnings? When there's a recession. There you go. So the fear is about a recession, and not only the fear. If you look at the stock market prices, not the estimates, the prices, it's already in the pricing that we may have one in 2019, or maybe 2020, but as early as 2019. So now that gets into the second segment of the podcast where I talk about a recession coming. To be honest and fair, I start with saying I don't actually have any idea, right? I'm no economist. Even if I was one, I should be honest to say I don't know anything anymore than a lot of other people do in the markets. Everybody has opinions, and that's all about. But I know what bull people are saying, people on the bull side, people on the bear side, and I stand somewhere in between. I'll tell you where I stand, right? So people on the bull side would say that neither is a slowdown here or a recession. People on the bear side would say the recession is already here. I'm going to give you two things, a fact and a fear. A fact is that the slowdown is occurring. I cite various sources, various numbers, and FedEx, a company that is very susceptible to the economic trends and very cyclical. Its management team is basically run by a bunch of economists who are really good at what they do. And in their conference call, they said specific things, which I read out word by word. It's real. It's not a fear. It's real. Slowdown is happening. Europe, China, US. The slowdown is happening faster globally, slower in the US, but slowdown is happening. That's the fear. Fact. What is the fear? The fear is a recession. Now, technically, recession is 2 quarters of GDP negative growth, whereas a slowdown is a slowdown from high growth to low growth. So what is happening now? Fact, slowdown. Fear, recession. Let's differentiate between the two. So what happens now? Let's take an example of a slowdown, right? So the GDP is, for example, 3%, goes to 2, goes to 1, goes to 0.5. What is that? A slowdown. If it crosses 0, goes down, negative, stays negative for 2 quarters. What is that? A recession. So the fear is that the slowdown that's happening will not stop here, will keep going on, and it would go to a recession. Now, nobody knows whether it will stop or not. We don't know, you don't know, I don't know, I don't pretend to know, okay? But the fact of the matter is that not all slowdowns result in a recession. And every time the economy gets to a slowdown, the markets correct as if it's a recession. It's pricing in a recession. Like if it's a recession, many people are pulling the guards off and being more safe about it, but it may or may not be one. We don't know yet, and that's why I'm saying it's buying, but not a screaming buying, because we don't know yet. Now, 2011-12, 2015-16, twice in this decade itself. What happened? Slowdown. What did not happen? Recession. What happened to the stock markets? It crashed. Both times, it corrected. Not crashed, but it was a great buying opportunity. So, this time, hopefully, I think it's the same. But we don't know yet, because we haven't seen where it stops yet. So, what is different though? What is different on 2011, 2012, and 2015, 2016, and now is the Fed mandate. The Fed was pretty much loosening both times. Now it's tightening. Not only the balance sheet, but raising the rates. Now, that is what worries me a slight bit more than it did in 2015-16 when I came out and did a podcast. Then I did a YouTube video saying the same thing, that you should buy. This is a screaming buying opportunity, right? Now, many people say Fed has lost it. Fed is out of touch. I believe that the current Fed is slightly out of touch and is not good at communicating at all. But that doesn't mean the Fed is entirely at fault. If the economy is doing really great, the president says it's doing really great, it's doing good, I think, not great, but doing good, then the rates should go up, right? We shouldn't blame the Fed for that. It's just that it's not communicating well, that it's a little bit more flexible than it appears to be. Hopefully it is. So, another thing is, Fed has in its mandate to protect the country. GDP comes as a result, but it looks after the inflation and the unemployment rate. Now, the country is doing great, right? So the job numbers and unemployment numbers are coming in good. So they're okay to raise the rates. Their mandate is not to look after the world. Now, what happens is, today, how interlinked the whole global economy is, U.S. can't stay independent. If the global growth is slowing down, U.S. growth will slow down too. I don't know why there's a traffic congestion here, but anyways, many people probably coming into the city. So the U.S. growth will slow down too, but the Fed doesn't look after that. Now, historically looking back, how much far I can recall, no U.S. recession has occurred because of the global slowdown. But today the world is more interconnected than anyone before. So we don't know. So Fed is not worried about the global slowdown, it's worried about US data, and US data is looking good. That's why it's raising rates. But talking about markets, 45% of the S&P profits come from overseas, right? So if global growth slows down, market is way more worried than the Fed. And that's what we're seeing. Fed is not worried, which makes market worried even more. First, the profits are falling, and second, the Fed is not caring about it. So that's where Fed stands, and that's why it's doing what's doing. Now, the main question comes, what do you got to do, right? What you should do? I answer that in two parts. One, if you're buying index funds or making any macro level decisions about a 401k, I think you should add for sure. Anyways, I say always you should dollar cost average, but when the markets fall, you should definitely add. Right now, you should definitely be adding much more than you would add otherwise in your installments or monthly programs. Second, going to stocks. If you're buying individual stocks, what I said is buy only the stocks that have given you no worries about a slowdown in the recent earnings reports. As in, they haven't given you any chance of worrying about the business. They're the stocks who have strong growth stories. And right now, when the market correction is happening, everything is falling, you're getting those stocks at discounted prices. So listen to the podcast, it's SunnyPoint Investing. There are list down stocks, 7 stocks I think I list, which I find the earnings story is really strong. The business is really strong. It's only that the price is deflated. You should take advantage of it. SunnyPoint Investing, listen on new podcast episode or platform you'll find it on. I'm here now having lunch and looking at some festivities. I hope you take advantage of it because it is just $1.99. Just kidding, it's free. And hope you have a really good end to 2018, start to 2019. Ask many questions you have. Comment me or send me a message, and I'll cover in the next episodes. Happy New Year.